But as the underlying appreciates more, I think you're going to see more investment in areas. So I think that I want a piece of gold miners as my hedge if it gets stupid in gold. Look, a gold could go down from here. Okay, that probably means other things are stable and steady. But if gold rips up here, I want to have some exposure.
Yeah, so you're saying there's just a natural tide shift that's taking place that was bound to happen at some point, and it's like moving the Titanic. It's slow, but then there's going to be various accelerants like the political shift that could happen, or something else that might come that would accelerate the shift that is already underway naturally. That's moving slow. Is that?
Yeah, I mean, look, just recently in the last day or two, the Chevron doctrine just came, and it basically said to the regulators, the EPA types, back off a little bit. So this is a little bit of conservative resurgence. And again, I don't want to get political. I like to make investments based on opportunity, risk, reward, not about whether you're red or you're blue, or it doesn't matter to me. I don't really care. But the tide is slowly shifting, and think about how big that bubble was. That even so the way I look at this, Gary, is, as I said, the tech space is let's call the big six, like, I don't know, 14 trillion, okay, roughly. The energy sector of the S&P, it's under $2 trillion. The whole sector. Let's call it 1.4 for just keep numbers. 14 trillion, 1.4 trillion. If 10% of the big tech said, you know what, I'm too big here, I got to sell some, I got to move some liquidity around, they take out 10% of 14 trillion, 1.4 trillion, that's double the energy sector, right? So if they said, you know what, I need to buy some energy, even half of that money or a quarter, it's going to jump that sector massively. And that is what happened in the fall of 22 into 23 when Putin took Ukraine. And
so you mentioned that the energy sector was down around 2.5%. Then when he took Ukraine, it popped to maybe 6% or something. Yeah, roughly. Yep. Yeah, and I feel like from my memory, if I'm correct, the historical mean is somewhere around 13-15% for energy. Is that correct?
Sure. Yeah.
So do you think in this cycle, that this tide shift that's taking place, are you expecting this sector to jump from 6% and maybe even it'll mean revert up to that 13 to 15%, maybe even pass it a little bit?
So it's trickier. So it's more readily tangible to sort of get a macro view on things. Right? To understand and expect how the flows go and how it evolves is harder. I mean, look, I was looking at the gold stocks, okay, and the price of gold, where it is, versus the price of Neuman and Barrick and the gold stocks versus where it was, 04, 11, now. If I told you where gold was then and where it is now, would you say, oh, those stocks have to be so much bigger? They're not, right? So there's those disconnects of where macro themes and theses, if you will, don't always align. But I would say this: we need oil, we need energy, and there are those out there who are trying to reduce our availability of it, our accessibility of it, and then there are those who say all the clothes we wear, all this and that, and the retrofitted economy of 100+ years. You're not taking that away so fast. So, look, I think that if we had a little more bellicosity in the world and oil went to 120, sounds like these oil companies are cheap. I don't know. But for me, that's where I want to be. And, the funny thing is, Gary, I watch these names. Currently, I'm not as exposed in energy as I was, mostly because they've just stopped working. Not because they've gotten cheaper and cheaper. And energy is holding up, and I just can't understand someone is out there selling these stocks. So when
What's
you say,
interesting is Warren Buffett continues to buy. He's loading the boat.
and he's not 93, right? I don't. He may not see the greatest appreciation of it all. I
He
don't
might
know.
not.
I don't know. But yeah, no, that's right. And look, I speak to a lot of value guys, and some of them have actually very recently in this year thrown in the towel on energy. And as much as I love these guys, I say, look, you got to keep a sliver of energy in there. Even call it the schmuck insurance. Don't be a schmuck if it goes up, right? But so I'm watching, and I'm nimble enough, and I don't have. I mean, whatever. Me moving into a name is not like a big fund moving into a name. I can do it pretty quickly and easily. So I'm pretty nimble, watching energy and waiting. But I've been involved in that for a while, so it's on my radar on a daily basis.
Yeah. So, Mark, by some estimates, there's been a CAPEX shortfall of $3 trillion in energy over the last decade. I don't know if you've heard that number before, but do you see, because of that CAPEX shortfall, do you see supply issues? Do you see price, rising, or it has to stay higher in order to incentivize, new well discoveries, et cetera, and all the things that come along with production?
Well, so the cost of doing business has gone up for everyone, right? They're not, everything's expensive now. And energy is not something where you can just flip on a light switch and we're back in business, right? So it takes a while, takes a lot of planning and a lot of, losing money at first to get started, to be honest. So the idea of new groundbreaking is probably cost prohibitive. At $100 in oil or 120, well, maybe it's less so, right? And I think that that's how that works. But I think that there's also been an overarching message: energy bad, disincentives, penalties, regulatory, even to a point where, right, some of the banks were being chided and penalized for lending to certain oil-related projects. So again, Gary, that's constraints on capital, right? And that's where eventually the lid pops off. It just does, one way or the other. And if oil spikes to a lot on some more global issue, all of a sudden it's like, hey, that project that didn't look so good at $80, well, at 120, I can sell some forwards, and all of a sudden I'm in business, right? So I think that those, to me, the constraints on capital idea is a beach ball held underwater. You can hold it underwater as long as you want, but at some point, it's going to pop and go. And we just need to sort of be there ready. And that's why I look at it as a diversification item. If you're long NVIDIA and Microsoft and Google and all, good on you, man. Well done. I would say trim some of the unruly branches and buy some of the seeds that are being sown currently. And I still think that energy is, and to be honest, I actually prefer some of the second tier energy guys. I don't, Exxon and Chevron, sure, you're going to always be fine there. But I actually think you can get a little more leverage and beta in some of the second tier stuff. It's idiosyncratic there. You got to know a little bit more about each company. But I think that is where some of the real juice could be made. Plus, I think there's probably some consolidation that occurs as things start to return to exciting. But look, I don't want to pick a winner here, but if the political landscape shifts enough, I think these energy companies are probably 15% better very fast when the market realizes that.
Yeah, that's good.
That's just an opinion, but that's me.
Yeah. No, that's good. That's good. So, Mark, how do you see nuclear fitting into the energy picture? The AI data center demands that are just skyrocketing the energy needs. The consumer class is growing by leaps and bounds over in Asia, in the Asian circle. The electrification of everything. I mean, the list is just endless. The demand pull on the grid and the need for energy just seems to be exploding. So where do you see nuclear fitting into this picture? Are you investing in uranium, and how?
So I think that it's ironic, the nuclear space competes with fossil fuel. It does. It does for a highly efficient storage of energy and delivery of energy mechanism. Fossil fuel and nuclear, they are, I go with the marble of uranium versus a ton of coal. They're the same, more energy in the uranium marble, and the clean nature and the danger, it's not even close. So when people talk about these two things, I feel like there's a ulterior motive out there. So I think nuclear, if you're looking for clean and sustainable, that's what it is. I mean, the nuclear subs that the U.S. has they're out on the ocean for 6 months at a time. They're powered by nuclear. Hello.
Yeah.
Right? Like, what are we doing? And so when I see,
there's a lot of discussion actually about those very small modular reactors that are in the subs, powering the subs, to be able to use for businesses, data centers, et cetera, rather than having massive nuclear power plants that take years and years and years to build and power, cities. Instead of that, there's a lot of discussion about for business, specifically for businesses, to go to what you're describing on, that's powering the subs.
So FLR spun out SMR, small modular reactor. Now, this is a very speculative stock. I just want to preface this: it's a speculative stock, highly volatile, and it's all over the place. Now, I'm a Reg FD. I'm involved. This is just something I picked up a little bit. It's not a recommendation. Everyone do your own homework. SMR is a spin out from Fluor, and I think it's a legit effort and energy. The fundamentals don't look great at this moment, but look, I think it's sort of one of, if not the first mover in that kind of space. That's just something in terms of URA, you mentioned uranium.
Yeah.
I have a little bit of, I'm a little circumspect on some of those ETFs representing those commodities. If the investor is sophisticated enough, I just kind of prefer holding a futures contract if you can. It's not for everyone. You got to have a certain net worth. But I find there's a little too much slippage in some of these commodity-based ETFs. That's just me, a little bit of a skeptic, but that's it.
But you do see, it sounds to me like you do see nuclear as a substantial, maybe not, overtaking fossil fuels in any way, shape, or form, but a substantial component to the energy needs as we move forward. So
in my work that I did a couple years back, I was speaking with an energy expert named Anas Al-Haji, an oil and gas guy out of Texas, very smart guy. And he basically said, if you believe in peak oil, you have to be a supporter of nuclear. If you believe in fossil fuel polluting the air, which it does on some level, but so does everything on some level, you have to believe in nuclear energy too. Those are just sort of borderline irrefutable. It's just a case of, look, Nextera, NEE, right, is interesting because it is involved in nuclear. It's also one of the greenest energy companies out there, and it's a utility. Mm-hmm. So to me, that one's, like, again, I'm not picking stocks here. That's not really what I do. But Nextera is a way to be involved in all the evolving newer energies, and they're a big, safe name that is there and will be there. They're involved in a bit of nuclear. They're involved in green, regenerative. I think that's an interesting one. Again, just as diversification, have for a while.
Let me shift us over to gold. Mark, what role do you see gold playing in the global financial landscape in the years to come? Especially with the challenges, of our treasuries, and China has been decreasing. I think they're down to around 800 billion in treasury ownership. Japan is struggling, so they can't. They may have to be a seller. Russia's not buying. There seems to be some challenges on that long end of the treasuries. What role do you see gold playing as some of these countries are, de-dollarizing and are looking for alternatives, from the SWIFT system, et cetera? What role do you see that playing on the global financial landscape in the years to come, and how important will it be for the generalist investor to own some gold?
Well, again, I think this goes to some degree to an underinvested space, right? You still have a lot of people, oh, it's an old relic and these kinds of things. And with the advent and evolution of Bitcoin, for example, you get a lot of people who normally would potentially invest in gold to say, oh, Bitcoin's the liquid gold. The digital gold, excuse me. I think that one of the glide paths I have in the gold sort of Bitcoin relationship is if there's a fly in the ointment of Bitcoin. Okay, I'm not making a call here. I'm just saying if there was a growing specter of doubt, and maybe look, on some level, Bitcoin is to me a measure of speculation in the market. That's the way I view it. And if enough people turned and ran and lost some faith in Bitcoin, I'm not saying how or when or if. I'm just saying, well, I guess I'm saying if, not how or when, but if there could be a further migration from Bitcoin to gold, right? So gold's been around 5,000 years, more than that, right? Bitcoin's been around, I don't know, 5,000 weeks or something, like, not as long. So I think that that's one angle. And again, I think that there's no faking it. There's no one person dominance of gold, which, Bitcoin could be very sparsely held by a few large whales potentially. So I think that gold deserves a place in everyone's portfolio for sure. Again, we talked about palladium as an ETF and palladium the ETF. GLD, the ETF, to me is not my favorite way. I actually I have some actual species, real coin that I have, and in small bits and whatever. I also own some of the miners. And to me, there's a couple out there that are sort of, what if gold goes to 5,000? I'm not saying it will. I'm not saying it does. But if it does, I'm positioned in a spot where that's an insurance policy that I have via some of these miners, some of the smaller miners too.
So, yeah, that's a really good segue. I wanted to ask you what your opinion was on the miners. The gold was range bound in that 1,600 to 2,000, for almost 4 years. And then it broke out and it's been hovering now above that 2,000, and as high as maybe 2,450, but I think it's around, we'll call it 2,300 for the sake of this discussion. It's really been holding steady above that breakout point and substantially above it for a while. Pretty soon these miners are going to start reporting much better cash flow numbers than they were for several years. Do you have expectations that are positive on the miners, or is it more speculative, or are you, as long as gold remains broken out and even starts to go higher, are you expecting the miners to be a leveraged play on that at some point?
So I wrote down some stuff this morning as I was looking. In 2004, gold was $430. Newmont Mining was $44. Barrick Gold was $20. Then you fast forward 7 years, gold's done a three-bagger. It's 1,700. Newmont Mining is up 50%, and Barrick, is up 1.5 times. All right, it works. Then in 2021, gold's up a little more, $1,800, $1,900. Newmont Mining is squeezed up a little higher, and Barrick Gold has got cut almost in half. Now we're here in 2024 at 23.20 gold. Newmont Mining's back to $41, and Barrick Gold is $16. Now Barrick, I think, was involved in an acquisition and that kind of stuff. So there's some other moving parts there. But as we talked about earlier, the CAPEX, right, has fallen in general. Things are expensive to do business. But as the underlying appreciates more, I think you're going to see more investment in areas. So I think that I want a piece of gold miners as my hedge if it gets stupid in gold. Look, a gold could go down from here. Okay, that probably means other things are stable and steady. But if gold rips up here, I want to have some exposure. And I It's my OS, my OSH handle. You
Yeah.
know, it's in case. I'm hanging on just in case. And it's not a huge allocation. I don't have 50% of my stuff in that, but I don't have zero either, right? And if I could say anything at this point, it's like whatever your tech portfolio has done in the last bunch of years, I'm sure it's gone something like this, and I'm sure your gold related has just sat there sort of vibrating. I would just take a little bit, especially if it's long-term gains. I would take some of that and just buy a little of this, and not all of it. Don't sell the farm, but I just want a little bit more. And I mean, look, we could be heading into a November with a million permutations of why things could get nutty.
Yeah.
From overseas, China, Taiwan, Russia, Ukraine, Israel.
Kind of hard to believe that it hasn't gotten nutty yet.
Well, that's what it feels like some people are keeping the guardrails on. I don't know who the some people is. I don't mean to get all conspiracy and whatever, but it's amazing how steady and steady as she goes it's been. And you could almost point to, again, I don't want to throw stones, sling mud, but you could point to the Fed and Treasury sort of making sure things don't go too chaotic.
Well, let's stay on precious metals for a moment, Mark. Silver's demand is rising due to multiple factors, including the electrification of everything, artificial intelligence in the data centers, advanced weapons, a quickly growing global consumer class, and many, many more reasons. Also present is the fact that only 1/4 of all silver is mined from dedicated silver mines. The other 3/4 is mined as a byproduct from other types of mining activity like copper, nickel, etc. All of this has put silver into a supply-demand deficit for the last 4 years plus running. And nothing imminent is suggesting that deficit is going to change moving forward. What is your silver thesis, and what are your expectations for the silver miners?
Right. So silver has obviously far more industrial uses than gold does. Right. And so there's a natural bit of, I don't know, real demand is maybe not industrial demand, let's say, versus gold, which is mostly ornamental. Okay. But no, I think that silver and my view is the gold silver ratio is probably as wide as it's been in a long time. So on a relative basis, I think you want some silver too. I own a couple little bits of silver miners too. I just think that at some point the gold and silver barbaric relics, I think that evolves and changes over time when a little bit more of the, I don't know, I want to call it reality sets in, because I feel like we're in a bit of a metaverse induced virtual, everything's good and great and fine and there's no real issues out there. But I don't know. I've been through many cycles. I started in this business in 1994, 30 years ago, in Japan, where it was a train wreck from the day I got the job, right, on a bubble wind down. So I tend to look at things realistically, less optimistically. That cuts both ways. But I think that we're in for a bit of a monetary reckoning. We are, at some point. And I think gold and silver remain sort of places there's just less chicanery that can be had in gold and silver.
Yeah. Is there a trend that you're watching for to play out over the next 1 to 2 years that you're paying attention to see if it does? And why would that be important to you?
So I come from a generally more value-oriented approach to things. And the value guys have been run out of town. In 2000, Cliff Asness, AQR, he was almost bankrupt. And he decided to go all in on the value over growth trade in 2000. I think his dad stoked him on the last bit of chips in the pot, and the rest is history. He made a killing. Because that decade and a half period, let's call it, was really where things reverted, came back. I mean, yes, you had spouts of big tech moves and growth moves, but the value resurged. And I saw recently David Einhorn, another big value guy, was basically like, markets are broken. And I think that's probably an utter frustration as much as anything. Not that the markets are behaving orderly and normally, let's say, but I do think that there's going to be a surge, a cyclical surge back towards value at some point.
Yeah, so the takeaway that I'm hearing from today, the theme, whether it be the ESG orphans, oil, politics, precious metals, you name it, value. It just seems, or even this illusion. It just seems like what your theme is really this reversion to the mean. Like things are gonna be coming back to, we'll call it a more central, more balanced place than they have been for the last 10 to 15 years. So, this has been a wonderful conversation. Before we wrap up here and I ask Mark our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com. Put in your email address to subscribe and receive the free gift on us. Also, I'm positive that you've enjoyed this conversation with Mark as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. It's now time for our Golden Nuggets segment. Mark, let's discuss portfolio positioning. Based on all we've discussed today, and with your Wall Street experience and your worldview as your backdrop, how are you positioning for the next 1 to 3 years? What assets do you like, and what assets do you absolutely want to stay away from?
Thanks, Gary. Yeah, I want to be in under-trafficked, under-followed names that have been discarded, names that have been kicked out of everyone's portfolio, and names that are the antithesis of NVIDIA, Apple, Microsoft, and Google. I just, see how the concentration is there. So, look, I like dividend-paying names, and I don't smoke, but Altria at 8% dividend, nobody owns that name. Everyone hates that name. It's going to be around. Like those kinds of names, some of the tobacco stocks. I don't really drink that much either, but the alcohol stocks have been, crushed. I think that those are, again, under-followed, under-trafficked names. And look, I still think fossil fuels. Again, I think that if I'm looking at dividends, cash flow, quality companies, low beta, somewhat defensive, and I just think that you got to be in areas where people don't know the names you're in. And I don't mean that like in a secretive way. I mean, people, I've never heard of that name. Now, there's a lot of idiosyncratic risk in that, right? You have to know your names, your companies that you're investing in. So it's not for everyone. As far as sort of a broader portfolio view, I would say that you need to have some energy, XLE, let's say. I think you need to have some utilities, would be the XLU. And again, I mentioned, like, to me, tobacco, again, I don't smoke, but as a guy looking to manage some money and whatever it is I do, 8% dividend on Altria or 5.5% on Philip Morris, they're not going anywhere, and they're going to be at the forefront of whatever those industries evolve with as the next product.
So you mentioned earlier volatility. Mark, how are you playing the volatility side that you are expecting to increase towards end of year, and what's your thoughts on the long bonds?
So I'm going to take that in two parts, Gary. In terms of volatility, and again, options trading, you need to be a bit sophisticated. I don't want to tell everyone that this is for them, I think that you can protect your portfolio with some options on whatever it is you have. So whether you're correlated to the S&P, you could do some SPY options. Whether you're correlated to the IWM, which I tend to be because I'm not in those big tech names, is IWM options. And I always say, I think I said it earlier, a portfolio without a hedge is just the market. So if you want to be long only, okay, I'm okay with that. I tend not to want to be long only. When the market rolls over, I want to be a little bit insulated. In terms of the bonds, one thing I think is worth noting is the yield curve just spiked pretty dramatically in the last 5-7 days. One of the biggest spikes since I think September of this past year. And so there's a lot of supply issues in bonds. Some people may not have enough demand. Like Japan has their own issues now with their yen going crazy. They may not be able to focus as much. They might even have to sell some bonds in the U.S. So I think that if I'm watching something specific for volatility, how far those yields spike higher? Because everyone said we're cutting rates this year. I mean, by September, we're supposed to have a 65% chance of a spike, and by November there should be one cut, according to what expectations are. I'm not so sure.
Yeah.
I'm just not so sure. And so if rates stay firm, that's going to be an additional source of volatility, in my opinion.
Well, Mark, again, this has been a fascinating discussion. Thank you for coming on to the Metals and Miners podcast, for being so generous with your time, your analysis, and your ideas. It's really been incredible to spend the time with you. Would you please share with the viewers any final thoughts that you want to leave with those tuning in, where they can learn more about your work and how they can connect with you?
Sure. So I'm available to be reached at mark@constrainedcapital.com. That's M-A-R-K at constrained, CONSTRAINED, capital, CAPITAL.com. And I'm happy to engage and talk to folks about, what I'm seeing and hearing. I did a ton of research on all this ESG orphans and stuff. I consult with folks and give that out to people who have conversations with me. So I'm happy to share insights. Feel free to reach out. And Gary, thanks for the time here. This was a great hour-long chat.
Well, wonderful. Yeah. So everybody, I'm going to put the information up on the screen. By the way, are you on Twitter, X?
I am.
Yeah.
At Mark Neuman 18.
Okay. So I'll put
Neuman 18. Yeah.
Okay. So I'm going to put that up there too. Everybody, if you believe in a reversion to the mean taking place, if you believe that there's been some misallocation, malinvestment in the marketplace, if you believe that the forced focus towards ESG is going to revert back, there's going to be flows coming back. If you believe that CAPEX into value names has been lagging, if you believe in a reversion to the mean taking place in the coming months and years, Mark is an important follow. Connect with him, follow him, pay attention, look at his fund. I think we're in for a wild time and for some changes to take place. And so he's somebody you want to be following. So Mark, I look forward to having you back on sometime soon. Thank you for being here with us, and everybody else, thank you for watching.
Thanks, Gary.
And I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us.